Preferred equity is a highly customizable financial instrument that blends features of both debt and equity. Its legal rights, structural features, and tax accounting treatment are defined by contract, corporate law, and regulatory standards, making it a powerful tool for investors and issuers seeking tailored risk, return, and governance outcomes. What is preferred equity? Preferred equity or preferred stock is a class of ownership in a corporation that sits between debt and common equity. It offers investors priority for dividends and liquidation proceeds, often with limited or conditional voting rights, and can include features like convertibility and redemption. Its terms are set by the corporate charter and negotiated agreements, making it highly flexible for a range of corporate finance and investment scenarios. What is preferred equity? Preferred equity or preferred stock is a class of ownership in a corporation that sits between debt and common equity. It offers investors priority for dividends and liquidation proceeds, often with limited or conditional voting rights, and can include features like convertibility and redemption. Its terms are set by the corporate charter and negotiated agreements, making it highly flexible for a range of corporate finance and investment scenarios. Preferred equity encompasses various types, each tailored to meet specific issuer and investor needs. Cumulative preferred stock ensures unpaid dividends accumulate, offering priority in payment, while non-cumulative preferred stock provides higher yields but forfeits missed dividends. Participating preferred equity allows holders to share in excess profits, unlike non-participating, which limits returns to fixed dividends. Convertible preferred stock offers upside potential by allowing conversion into common shares, while redeemable callable preferred equity gives issuers the option to repurchase shares. Adjustable rate preferred stock ARPS links dividends to interest rates, providing protection in rate-sensitive markets. These classifications balance risk, yield, and flexibility, making them versatile tools for public companies, private equity, and venture capital. Preferred shareholders gain voting rights, board representation, and anti-dilution protection. Protective provisions include veto rights and consent requirements for major decisions. Drag-along tag, along rights coordinate exits while protecting minorities. Information rights ensure financial data access and oversight. Enforcement mechanisms provide legal recourse and ensure fiduciary accountability. In essence, preferred equity offers a robust legal and governance framework and enforceability. Tax stamp accounting treatment summary classification. US GAAP allows temporary equity for redeemable shares, while IIFRS classifies them as equity or liability. Dividends generally not tax-deductible for issuers. Investors are taxed at qualified dividend rates 0-20% if holding period requirements are met. Redeemable shares holder optional redemption is classified as temporary equity or liability under US GAAP, and as liability under IRS mandatory redemption. Treated as liability or temporary equity under US GAAP, liability under IRS. Interest-like features may be recharacterized as debt, allowing interest deductions for issuers and taxation as interest for investors. Preferred equity is widely used across industries for its flexibility and balance of risk and reward. Public companies issue preferred equity to raise capital without diluting voting control. In private equity and venture capital, convertible, participating, and redeemable preferred shares are employed to align investor and issuer interests while managing risk. In real estate, preferred equity fills gaps in the capital stack, offering fixed returns and priority over common equity, making it a popular choice for mitigating risk and ensuring predictable returns in volatile markets. To summarize, preferred equity offers priority returns and legal protections but is junior to debt. Legal rights are highly customizable: voting, board seats, anti-dilution, and more. Tax accounting treatment depends on structure. Dividends are usually not deductible, and classification as equity or liability varies. Best practice: always review the corporate charter, stockholder agreements, and applicable law to understand the full scope of rights and obligations. Preferred equity is a versatile instrument that can be tailored to meet the needs of both issuers and investors. Its legal rights and protections are defined by contract and corporate law, with significant implications for governance, enforcement, and financial reporting. Careful structuring and precise drafting are essential to ensure the intended economic, legal, and tax outcomes.